Well, welcome back to part two of my discussion with Joe Kim, the portfolio manager for the Montgomery Fund. In this section, I want to take a little bit of a dive into reporting season, exposure to Russian stocks and economy, take a deep dive into a particular stock, and then some general thoughts on investing in the Montgomery Fund. Joe, firstly, we've just come out the back of reporting season, which seems to have maybe fallen away a bit with the war in the Ukraine, but maybe you can just give me your thoughts around reporting season, your key observations, takeaways, and any sort of outcomes as a result of that for investors.
Well, Scott, we entered reporting season quite cautious on the outlook, and there are four main reasons for that. So the first one is the supply chain disruptions, and we did have a few companies sort of pre-report on some of these supply chain issues that they've been encountering. Now, the second part of that would be the COVID disruptions, and so we've had a lot of shopping centres closed, we've had retail closed, and that sort of feeds in partially to the supply chain disruptions that we've seen more broadly. The third thing is rising costs, and one of the themes of this reporting season is there is cost inflation. Now, the most prominent one is wages, especially in the tech sector, where we've saw 10 to 15% increases in wages across a lot of the higher skilled labour, especially in tech. And finally, we've had rising rates. And so rising rates is less of a risk in terms of the companies themselves, but more of a risk in terms of the valuation profile of some of the longer duration companies. So not a lot of places to hide. Now, one of the bright spots from reporting season was the banks. And there were a lot of concerns going into reporting season that banks would feel the full pressure of competitive pricing in mortgages. We thought that the bottom was in because you saw a lot of the competitive pricing pull away in October, and now being the biggest beneficiary of a rising rate environment, we have seen a bit more investor enthusiasm coming into the banks. We've retained our big banks exposure. It's the biggest bank exposure that the Montgomery Fund has had in its history for that reason.
Okay. Big question for everyone at the moment. The Russian invasion of Ukraine, we're an Australian equity fund, but do we have any exposure in our portfolio to Russia or the Ukraine? And I guess with all of the sanctions going on, how do you look at that risk for Australian companies in our portfolio?
Sure. Well, Scott, if you think about Russia and Ukraine, there's obviously, the world is so connected that, this will impact almost every company one way or another. There are going to be some, obviously, pockets of companies which are just Australia exposed, but it's very hard to avoid that. Now, our view of the Russian situation was we weren't expecting the war to be our base case, but obviously when it broke out, we quickly went through our portfolio and determined whether we had the appropriate risk or exposures, and what companies had exposure, and do we think that exposure is large or small. And one of the first companies that came out when we did this analysis was Aristocrat. Now, Aristocrat, for example, has a digital business where the gaming side, they've got some studios in Russia and they've got some studios in Ukraine. And one of the first things we did was we spoke to the company, we asked them, what's your exposure? And they effectively addressed those concerns in the past couple of days, where they were anticipating the potential for a war, and they'd been relocating a lot of their team out of those countries. And so we thought, well, yes, the share price is under a bit of pressure, but we do think that's a very small exposure that over time the market will become more comfortable with, and we've seen the share price recover as a result.
So the fund has no direct exposure to Russia in any stock-specific issue?
It has very minimal exposure, Scott, so nothing that we are concerned about overall.
Joe, it's been a volatile start to the year for equities. Can you pass on any key notable buys or sells within the portfolio?
Sure, Scott. So the most notable buys and sells that we've had are actually in the banks. And so we've held, Westpac for a long period of time. It's underperformed last year relative to the other banks. And the most recent results showed some turnaround potential, but we do believe there's a lot more structural challenges that the bank faces over a period of time. And so we've elected to consolidate our bank holdings into CBA and into NAB. Now, CBA obviously is the quality bank. It's demonstrated leadership in the banking sector time time and time again. We feel very comfortable under investing in Matt Common's stewardship. NAB, we're seeing a lot of positive, operational benefits coming out of Ross McEwen's leadership, and with the bank being the most exposed to the business sector, which is recovering or actually seeing strong growth, we believe that those two exposures will best benefit our investors over the medium term.
Okay, any notable sells in the portfolio?
So we've sold a couple of positions. Tabcorp was one of the stocks that did very well for us last year. We've seen very good growth in lotteries, but on the flip side, we've seen wagering declining they're losing a lot of market share. And we are generally concerned with the trajectory of the wagering division, even though the lotteries business is going very well. We felt like, Tabcorp was undervalued on a sum of the parts perspective. Whilst we acknowledge lotteries is doing well, we feel that it's fully valued relative to the prospects going forward.
Okay, thanks, Joe. We talked earlier in the first part about Reliance worldwide. You want to take a couple of minutes just diving into that business and why it is, I guess, a cornerstone and a hallmark of a type of business that the Montgomery Fund would hold. So maybe you just want to spend a couple of minutes taking us through that stock.
Sure. So we introduced Reliance maybe 3 years ago into the portfolio, and Reliance has been a stellar performer during this COVID disruption, and the things that we like about the business, it's a very very good product. For example, first and foremost, the plumbers use it to save time. It's very important in this environment where the US is labour constrained to be able to find innovative solutions that allows the plumber to go and save time and do a good job for the end customer. So we like the product itself. And then there are some operational hallmarks of the business. Now, for example, their field performance. During COVID, everyone had supply chain difficulties, but if we look at the actual execution, they've seen a significant pickup on the revenue side of things. So, for example, Scott, I think their compound growth over the past 2 years in the US has been over 10%. Now, that's phenomenal for a business which is essentially making widgets but having supply chain disruptions. Now, where the share price is at the moment, we've seen the share price is around $4, which going into COVID, it was around $4. The earnings profile of the business has increased by about 50%, and they've actually made a couple of acquisitions to help that earnings growth profile. The ROE of the business has gone from sort of 11 to 13%. Now, we struggle to understand why the business is actually trading cheaper now than before. Now, we can see there are some concerns around sentiment in the US. There are some concerns around Reliance being a COVID winner, but again, our channel checks indicate that the backlog of work from the pro side of things, which is where they're most exposed, is very strong over the next 12 months. And so that's why we have this as one of the foundation companies of the Montgomery Fund.
Thanks, Joe. Okay, look, last question is, can you provide some overall, I guess, guidance as to the positioning of the Montgomery Fund as we sit here on March the 10th?
The overall shape of the portfolio is very similar to the one that we had in 2021. And so we have the majority of our investments are in quality companies. Now, whether they be in a quality growth company or whether they're quality defensive companies, the shape of the portfolio is still very similar. Now, we haven't used this resources rally to chase what we perceive to be less sustainable earnings over the medium term, and we have sort of got a bit more of a defensive positioning, and that's a result of the cash balance creeping up a little bit. But by and large, the portfolio shape is very, very similar, and so we're looking at some of these lower prices and looking at very more attractive entry points. We're reassessing what we believe is the risk around Russia, Ukraine, and rates. Markets are very, very fluid at the moment, Scott, and so we don't want to go lurch in one way too aggressively or another, but we are going to take advantage of what we perceive to be lower prices. For example, we've used some of the sell-off in Reliance to re-weight up our position, so we've bought more shares at a lower price, and those are the sorts of opportunities that we're looking for.
I think it's important to note at this sort of point in time where there has been significant weakness in the unit price of the fund, that when you're investing in equities, you really need to take a 3 to 5 year, 5 years plus real view. Anything can happen from quarter to quarter or even 1 year on 1 year. As we talk to you and we talk to Roger and the rest of the team, we have a portfolio of really high grade companies that have valuation on their side, and we need to let those businesses continue to sort of compound out, and the value will be realised that in the share prices over time. But we're in a risk-off environment at the moment, and so with that sort of sell-off comes depressed prices.
Absolutely.
All right, look, that's all we've got time for today. Hopefully you've enjoyed this little video insight. If you've got questions, please reach out to any of my team or anyone here at Montgomery, and we'd be delighted to get back to you. Thank you for your time.